This is a series of videos considering PLCs and the relationship with their share price and market capitalization. So within this particular video, I'm going to be focusing on market capitalization, just in terms of what it is, how it can be calculated, and why it's so important. So to begin with, the formula, as we can see on the screen, is price per share times by the total number of outstanding shares which have been issued. So it's the number of shares that have been issued that are outstanding. So it's the aggregate market value of a company, and it's represented in monetary terms. So since it represents the market value of a company, it's computed based on the current market price of its shares and the total number of outstanding shares, and it's commonly referred to as market cap. Now, I just want to repeat one point again. So just a reminder, it is based on the current market price per share. So the 100 largest companies in the UK by market capitalisation make up the constituents of the FTSE 100 index and represent roughly 80% of the market capitalisation of the London Stock Exchange. Now, the medium segment of the market is listed in the FTSE 250 index, which represents around 15% of the UK market capitalisation, and below that is the FTSE small cap index. An index of even smaller firms is contained within the FTSE fledgling index. Now, the FTSE All Share is the aggregation of the FTSE 100, the FTSE 250 and the FTSE Small Cap indices, representing 98 to 99% of the UK market capitalisation. So market cap is used for indicating the size of the company. Now, as mentioned when considering the London Stock Exchange, you can categorise PLCs via market cap in three ways. You can do it via small cap, mid cap, and large cap businesses. So in American terms, a small cap is when the market cap is under $1 billion. A mid cap is in the range of $1 billion to $10 billion, and a large cap business is 10 billion plus. And as you can see from the image, there are examples of US companies which will be categorized as small, mid, or large cap companies based on their current market capitalization value. And you probably guessed it already, but as you can see, Amazon and Apple are two companies or two examples of large cap businesses, and we'll look at them more in this video. With billions of dollars worth of valuation, a large cap company may have more room to invest a few hundred million in a new stream of business and may not take a massive hit if the venture fails. However, a mid cap or a small cap company make a similar value investment may be susceptible to big blows if their venture fails, as they just don't have that bigger cushion to absorb the failure. Now, if the venture succeeds for a large cap company, it may appear small on their profit numbers, but if the company scales up on that success, it can lead to profits of larger magnitudes. On the other hand, the success of such ventures for a mid-cap or a small cap can bolster its valuation to significant heights. Now, the valuations of mid-cap or small-cap companies often take the hit when there are reports of a large-cap company invading into their space of products or services. So, for instance, entry of Amazon into cloud hosting services under the Amazon Web Service, AWS, umbrella have been posing a big threat to smaller companies operating in this niche space. And therefore, if those reports, I suppose, are made public, you can imagine the share price might take a hit in the small to mid-cap because of the threat of a larger cap company. Now, generally, investments in large cap stocks are considered more conservative than the investments in mid cap or small cap stock. Though mid and small cap stocks often offer a high return potential, but clearly it's that high return, high risk trade-off. So it is going to mean higher risk taking investment because these companies they've not grown yet, okay? And the relatively limited resources at the disposal of such these companies make their stock much more susceptible to competition, to different types of uncertainty, and as we think about it at this moment in time, economic downturns as well. But if we're considering about large cap companies, because of their profit margins, because of their market presence, because of everything that they've already got in place, they're much safer in these types of situations.
Microsoft recently joined Apple as the only other U.S. publicly traded company to close above $1 trillion market value. Amazon briefly flirted with that point last year, but didn't quite close above that level. What ties these three companies together is the way that they've developed these products and services that have made such a deep impact into the lives of so many people on an everyday basis. And that sort of impact is not something we've seen even with other very large companies.
Today, Apple is going to reinvent the phone.
What made Apple worth $1 trillion, quite simply, was the iPhone. There's a lot of companies that make smartphones out there. There's no company that makes them so profitable as Apple makes them. Now, Apple's rise to success was by no means guaranteed. This was a company that years ago was just kind of this niche computer maker. And then Steve Jobs, the founder, came back to it, helped develop products like the iPod, and then they came up with this product called the iPhone, which came out in 2007.
And we are calling it iPhone.
That didn't obviously create the mobile phone business, but it really revolutionized that business to the point that phones became ubiquitous in your everyday lives. It's become an enormous business. In the last 8 fiscal years alone, Apple has sold more than $900 billion worth of iPhones. What we're seeing with Apple is that as the iPhone business has started to mature, the company is trying to pivot to focus on things like services that it can upsell to its customers. That has had some success. Services has become their second largest business line. The problem for them is that the iPhone is so incredibly big, still roughly 2/3 of the company's revenue, that it's very hard for anything else to make a dent of that size in the near term. It's going to take a while to see if that bet can really pay off.
Time is the most precious commodity in the late 20th century. And the fact that you don't have to drive, park, do all those things that make life complicated when you go shopping in the physical world is a huge advantage of online shopping.
What's interesting about Amazon is that they started years ago with this idea that people were going to go on the internet and buy books and have books mailed to you. And then over time, they spread their wings into more product areas that they would sell. But for so long, they were essentially an e-commerce company. And then in 2007, they announced this product called the Kindle. What the Kindle did is it gave the public its first taste of this idea that Amazon could be more than a company that just sold them stuff online. Now, what really began to drive Amazon's value up is when the company started reporting the impact of its web services business, what it now calls AWS. They built this infrastructure to service their own business, and they realized they built something that they could essentially also share and rent out to other companies.
For business applications, big data, or building games, Amazon Web Services gives you access to the resources you need to create sophisticated, scalable applications of any size or shape.
All of a sudden, you could grow a company without having to buy so much of your own network gear and build your own data centers. You could essentially rent out these capabilities from Amazon for a lower cost. It fueled companies like Uber and Lyft and Pinterest and helped them grow fast. It also fueled Amazon's growth. Over time, it had become a multi-billion-dollar business. I think Amazon arguably maybe has done the best job of any of these tech companies of diversifying in a big way to an entirely new business line.
In this video, you're going to see the future. Windows.
Which brings us to Microsoft. Here was a company that originally developed this Windows operating system that went on PCs, that went into almost every home and every business. That's what made Microsoft so valuable years ago. And then the company seemed to have lost its way for a while because all of a sudden the mobile revolution hit. 5 years ago, they had a big management shift come in. A new CEO came in, Mr. Satya Nadella, that I think helped focus the company more on what are essentially new ways to approach the business.
We now need to make Microsoft thrive in a mobile-first and a cloud-first world.
The new Microsoft wasn't going to be about trying to get everybody to use Windows or even Microsoft software. What they're trying to prime is usage of its own cloud. They are number 2 to Amazon in most of these markets and considered a strong challenger. These companies have been able to capitalize on a very long-running bull market in stocks. At $1 trillion, they're reflecting both their own innovations as well as how investors have come to value the market overall. Alphabet is probably next in line to hit $1 trillion at some point. It's seen some weakness of late, but the gap between it and the next largest company is wide. Google, as we know, accounts for the vast majority of the world's search activity, and it proves this point that companies that develop technology that becomes so deeply ingrained in everyday life are the ones that the market values at the highest.
So if we consider a larger cap company such as Microsoft, and remember in the previous video we said that Microsoft had reached that $1 trillion market cap and clearly exceeded it from the chart. So we can see the 24th of August this year, and they'd achieved a market cap of over 1.7 trillion US dollars. So if we want to kind of work out how that market capitalization was calculated, first of all, we need the share price, and roughly the current share price at that time, and it might not be exact, but for this example, we'll say the price was $205. So that was the current share price on that date, roughly. And what we need to do is we need to use the formula that we can see on the slide. So we have to pretty much reverse the initial market capitalization formula. So we'll get our 742.01, and we divide it by the $205, and we'd get the outstanding shares which are issued, obviously roughly about 8.5 billion. Right. So for this example, we're just going to use the market capitalization formula. So remember, it's the price of the share times by the number of outstanding shares which have been issued. So currently, the price of a single share is $50 for this company. Let's call this company Company X. So it's just a hypothetical company. And the price being $50, but the number of outstanding shares which have been issued is 25,000. So all we'd simply do is do our $50 times by 25,000, and what we'd get is a market capitalization of 1.25 million US dollars. So for the end of this video, I just wanted to just provide a little bit more information just to take away with you. Just some kind of final summary points. So to begin with, just a reminder, outstanding shares, we've mentioned it quite a lot within the formula, but to actually know what they are, they simply just refer to the number of shares of a company held by all its shareholders. So it may fluctuate wildly over time as more shares are issued. So in other words, all the shares that have been issued, they are the outstanding shares. It's based on the current share price, so fluctuations in the share price will be detrimental to the market cap. So in some of the other videos that I've done in terms of share price going up or share price going down, clearly that will have a direct impact on the market cap. If the share price goes up, then obviously that market cap, it'll highlight that. If the share price is going down, then obviously the market cap will go down, which will be suggestive that the value of the company is falling. But you do have to remember the share price does fluctuate massively, and therefore as does the market cap. The market cap is a measure of the company's worth on the open market. So just a reminder, it doesn't necessarily tell you everything about the company. It doesn't provide all information, but it is it's a good measurement of at that moment in time, what is the company perceived to be worth on the open market. It can indicate at what stage the company is at in its development, especially regarding its three categories. So small cap, mid cap, large cap, and that obviously all depends on how much market cap they're worth. And share liquidity refers to how easy it is to buy shares, and often small cap businesses are more liquid than large cap, so it's not as easy to buy shares in those companies. Probably just simply because maybe not as many shares being issued, but they can also be riskier simply just because of the stage of development they're in. They haven't got the financial backing behind them as, for example, large cap companies do, but also because of where they're at that growth of development, they could actually create a greater return because they've got so much potential market growth. And finally, just a reminder about the formula. So if the market capitalization is provided, so let's say you've got an exam question and you've got the market cap given to you, similar to the example that we did in this with Microsoft, then you'll have to rearrange the formula. And one way you might do it, so for example, maybe the outstanding shares are missing like we did before, and therefore you get your market cap and you divide it by your share price. If it's your share price that's missing, then simply get your market cap and you divide it by your outstanding shares.